Good morning, everybody, and welcome to our webinar, our IFRS webinar this month. And the focus this month is on finance teams, and in particular, what to look for when preparing your financial statements. Uh, and I think this is really timely, and Kevin and I have planned it this way because we know this is what you'll be focusing on at the moment, finalizing the preparation of your 30 June 2020 financials. We know that some of you might be sticking to your original timelines, but some of you might use the opportunity provided by ASIC to extend your lodgement of your financials by a month. So doesn't matter where you are on that range. You'll be busy with this at the moment. Um, so I would start off by saying good morning, Kevin. Nice
Good
to have
morning.
you on the webinar again.
Good morning, Aletta, and good morning, everybody. I have been away for a couple of months, so it's good to be back, and I'm glad to see we have such a good turnout today.
Fantastic. We also have two surprise panelists that are joining us this month, and they're joining us on a hot topic that came out of the risk assessment that a lot of you completed before the webinar. It also came out of a recent ASIC FAQ that was issued. And also a AASB FAQ that was issued. So I thought this is really relevant. We highlighted it last month in our webinar, and afterwards we received some inquiries. So I thought, let me get the experts in. So I've got Ben Renshaw, who's a tax partner, and I've got Mark Griffiths, who's a risk advisory partner, and they will later on share some of the work and the value they could add, helping you around remuneration and underpayment around remuneration. And you'll remember last month we talked about casual. So they are something that I'm hiding at the moment, but we've got them up our sleeve for later on. So the focus of today's webinar really is that we want to look at what should finance teams be focusing on now, this time of year. And we have been working with 6 Clicks to develop a financial reporting risk assessment tool. Now, I'm so excited about this because I like all things new, and I like technology. And this is an app. So you can see there's a screenshot from my phone. So if you use the link that we've sent out on Monday, you would go to this app, and you can see there's a little round BDO, financial reporting. I've put in 19 risks that I wanted you to assess. And it works in a very simple way that if you swipe left, you don't believe that risk is applicable for your organization. And if you swipe right, it comes up and it asks you to now assess that risk. And it will ask you to look at likelihood of it actually happening in your organization, and also if it happens, what's the potential impact. So it's nice mobile app, and we in this webinar will share the insights. So based on the responses we've received, we will share with you which financial reporting risks are common to the people who've completed it, which risks are likely to have the most significant impact on your business, and what can you do to effectively manage those risks when preparing your financial statements. So it's really, we've got all these people attending these monthly webinars, and we've been doing a lot of education around new standards. We've been doing a lot of talking about COVID-19, and this is just bringing all of that knowledge together and sharing that with you. If you haven't done it yet, you could use the link below and on the slide, and from your mobile phone. So you can't do it on your PC because the swiping left and right doesn't work nice on a PC. You have to use your mobile phone, and you can still do this assessment, and it will update our data, and we can share it in future webinars or LinkedIn, etc. So the opportunity is not lost by any means. So in the email, I've sent you some instructions on how to do it. It's important that you use your phone. But on this slide, I also wanted to show, you download the 6 Clicks Risk Review app. You sign up with your team name. Now that team name where I'm circling at the moment, you can put in whatever team you would like. So you could put in your company name, but you put in your email, etc., and then you can get started. And at the end, you receive a little bit of a risk matrix right on the right-hand side here, based on how you've identified the risks, how you've assessed it. You get a nice summary on how you view these risks applicable to your organization. And you can see there at the bottom, you can say, email this chart to me in detail. So you get all the detail sitting behind this risk matrix as you look at it. Now, what I've done on this slide, you'll see on the right-hand side, that red circle. I've circled the person in the plus there. So once you've done this process, so you've identified the risk that you think is appropriate and you've assessed it, so basically likelihood and impact, and you get to this risk matrix, what you can do is you can at that stage click on this little person on the top right-hand side, and you can invite other people in your team or your organization to also do this assessment. And as they do the assessment, this risk matrix, you can see it says their risk matrix is a team average. So this risk matrix and team average will be updated. So you will get up-to-date information how you and others in your team, so others in your organization, assess your financial reporting risk. So for us, the nice thing about this and the whole aim is, imagine if we can get a whole finance team to do a financial reporting risk assessment, and we can also get the audit and risk committee to do it, or we can get the board to do it, and we can then look at a risk matrix for your organization based on what the finance team and the board says. You could also go a bit further and say, we want to contrast and compare. Let's have a team for the finance team and let's have a team for the board, and compare if there's some kind of expectation gap. Let's call it an expectation gap between how the board assess risk and how the finance team assess risk. So I've got a lot of screenshots here. It also went out in an email, but the idea is to really help you to think about what are our financial reporting risks at a time when we are busy with the preparation of our financial statements. And I think it's a good time to bring it all together. So what we've done, and again, thank you very much to all of those that's gone through the effort to do this assessment. It takes less than 5 minutes. It is really a simple exercise. So, you swipe left to get stuff, rid of stuff that you don't think is applicable. You swipe right for the risks that you think are applicable, and only those that you think are applicable, you consider how likely is it and what's the impact. So really a smooth process. What we've done is we've then looked at an overall risk rating, and for the purposes of this webinar, we've looked at everybody that's completed it, so our whole population of webinar registrants. And when we looked at the overall risk rating, we've determined the order of the risks. And we'll be discussing, Kevin and I will be discussing the 19 possible risks in the order as flagged and determined by you. And then at the end of the session, I will share with you which of them, which were most, you decided were most likely to have an impact, which would have the biggest impact, and some other insights when we wrap it up at the end of the session. So that's the introduction. So if we look at that overall, can't believe it. Is it true that finance team come up that the overall risk is around cash flow? And if you look at cash flow, it's all around, the things that we've put in as common causes around cash flow risk is where dividend declarations are not aligned with our dividend policy. We can't meet our bank covenants. We're renegotiating payment terms on liabilities and creditors. We're renegotiating T's and C's with suppliers. Maybe we're renegotiating leases, including rent concessions. Maybe we're modifying our existing convertible notes, etc. So most people and an overall score, cash flow came out number 1. I find that interesting because most people would say commercially at the moment it's all about cash flow, and I agree. However, I didn't know whether people who are focusing on accounting standards will also come up with cash flow as the number 1 risk. So I find that absolutely fascinating, and therefore, even though we're accounting nerds, as they often call me at least, there's definitely some commercial reality in it. So potential impacts on cash flow risk, if it's not managed properly, obviously can decrease your value, have an impact on cash flow forecast, impairment of assets, etc. Now, the second one, which was really interesting, and obviously not, I didn't think this one will rate high, because I thought most people that would be completing this risk assessment would potentially be for-profit entities. So why would it be possible for the only risk that's specific to not-for-profits to win all or to beat all the other risks? But it happened. Our number 2 potential risk is the recognition of government grants. And we quarantined it to not-for-profit entities. So it must have scored really high by those not-for-profit attendees in order to get this high in the overall rating. So, obviously the risk is around the incorrect recognition of government or other funding received. We know there's a new standard, AASB 1058, 30 June 2020 is the first time we're applying that standard. It's definitely changing the way we've done it in the past. And there could be, common causes could be we don't have a clear framework to assess whether we've got enforceable rights. We might not have a clear framework around sufficiently specific performance obligations, but I think the key thing here for me is the potential impacts of this. If we get the recognition of government grants wrong as a not-for-profit entity, the potential impact is major. It has a negative impact on the ability to obtain future funding. And that's what not-for-profits need. And it has a negative impact on the acquittal process for our current funding. So it's all around the existence of this not-for-profit. So that was number 2. Number 3, as rated by our webinar attendees, complex transactions is a big risk. And the kind of things we were thinking about, if these things happen during the financial year, it would be a big risk for you. Obviously, if these complex transactions happen on a regular basis, usually clients have the system processes support in place to deal with this. It becomes like a normal for that particular organization. What we're more thinking about here under complex transactions are entities entering into new or unusual transactions for them during this accounting period. So I'm thinking about maybe we acquired new assets or businesses, maybe we, for the first time, use non-vanilla financial instruments. Maybe we pay our employees or key management personnel, our directors, our suppliers, not just with cash, but with shares or share options. Maybe we own investment properties. We incur research and development expenditure. And the accounting complications around that, and also the R&D incentives, and not just am I entitled to these incentives and do I have help to claim for that, but also if I am entitled to it, how do I account for it? There's so many variations going around. Do we use convertible notes to raise capital for the first time? Do we apply hedge accounting? So this was number 3. On complex things, and this could lead to incorrect recognition and measurement and disclosure of these complex transactions. And if we get that wrong, obviously there's modified audit opinions, there could be regulatory enforcement action. So complex transactions, big risk. Now, the next one, as you know, if you attend our webinars on a regular basis, I often throw poor Kevin under the bus by throwing over topics to him without telling him. I can assure you I have agreed the topics with him this time. So, Kevin, number 4 is yours.
Oh, thank you, Aletta. And impairment is certainly expected to be on the list. Now, I love impairment. Like Aletta loves leases and new technology, I love impairment, and I've been doing it a very long time. So of course, I'm happy to see this in the top 5. I would have expected it to be number 1, but it probably doesn't surprise me that it's number 4, because the 3 items just before this actually are all linked to impairment at the end of the day, because complex transactions and cash flows and complicated convertible notes and all those types of things, they all ultimately all lead to assets on the balance sheet that need to be substantiated through cash flow, because that's what impairment is all about. So in a way, impairment is really linked to the ones that just came before, especially on cash flow. Cash flow supports the carrying value of assets on the balance sheet. But the biggest thing with impairment, and I think it's the reason why it's on the list, is that it always gets left till the year end. And I think the reason why it's there is because it doesn't get the attention it deserves until right at the end of the year. And then what happens is it's a mad rush to try and make sure it all fits together. It's one of those poor little accounting standards that's left till the end, but it actually tells you a lot more about your business. And the worst part about the impairment standard is that only at the end, when you found out that you've left it right till the last minute, do you realize that things like goodwill have to be allocated to different levels in the business to be justified. And if you don't get that right, you suddenly end up with write-offs and losses. So the potential impact on this one is enormous. Impairment of assets is a decrease in asset value. It's write-off and a decrease in profitability. It has an enormous impact. So not surprised to see it in the list. And I think it's intrinsically linked to complex transactions and cash flow, which was number 1. Aletta, a revenue recognition. I think you gave me that one as well. I think in our agreement, revenue recognition, same thing. This is a surprise one in the sense that I don't really think revenue recognition is a big deal if you get it right. But I think the problem here is that revenue recognition, we haven't mentally moved from the old standard to the new standard. And the problem with revenue recognition is the revenue recognition, especially in complex arrangements or arrangements that go over long periods of time, don't always align with the cash flows. And notice how I'm linking it back to cash flows, because that's number 1 on the list. So revenue recognition is once again a poor casualty of cash flow management. I'll share a recent war story with you. We have a particular client who has very specific contracts with their clients or their customers. So essentially the bespoke terms and conditions, which is on the list that's on the screen right now. And what's happening in the board was very disconnected from the finance team, and the finance team was very disconnected from, shall I say, the sales team. The sales team was off making deals, which essentially disconnected cash collection from actual performance of or delivery of the goods, to the degree that the particular entity at hand has only 10% cash flow in their revenue in the current year, because the revenue, the delivery of the goods, has been completely disconnected from the cash collection policy in the organization, meaning that particular entity has revenue in their financials in the current year, virtually all non-cash, because the cash is being collected in a different accounting period, and EBITDA is no longer even closely associated as a cash measure in the business. That is a failure on just about every measure in terms of board, governance, accounting and audit committees, right down to what is the objective of the entity, delivery, sales targets, all those things. And it just absolutely kind of fell by the wayside. And who got blamed? Revenue recognition. So that's something really interesting to kind of pull apart. It's one of those things that's big on the list, because the revenue recognition is contract based. So it does reflect what an entity is doing in terms of managing its customer relationships, how they're actually collecting their cash flows, what their obligations are for delivery. And if that's left to fall apart, it doesn't necessarily reflect in your financials. So once again, not unhappy to see it in the list. It's connected to cash flow, it's connected to contract negotiation, and it's connected to governance management. Aletta, over to you.
Thank you very much, Kevin. And I think this actually highlights, Kevin, my view that we should get boards, audit and risk committees, finance teams, maybe sales teams, to complete this risk assessment so we can contrast and compare whether we've got expectation gaps.
Yeah, I think that's right, Aletta. Sorry to interrupt you. Can I just say that I actually think that might be the biggest learning I'm starting to take away. And this is all new. We're just doing this. So haven't actually completely gotten into what this is telling us. But start early, bring everybody in, and don't leave it till the last minute.
Absolutely. Thank you, Kevin. And then number 6, now this is where I've got my special guest around remuneration. Now, it's interesting. I wouldn't have expected remuneration to come up so high, but I do know that recently there's been a lot of talk about remuneration and how we account for it. And as you know, we talk about big brand risk for organizations. When organizations have to own up to not having paid their staff the correct amounts under the awards or the enterprise bargaining arrangements in place, it's a problem and it hits the media. And we've seen a number of high-profile people and companies have hit the media over recent times. ASIC had that FAQ on, casuals. There was a recent federal court case decision in May around paying casuals and, have we paid them enough? And this is really, really hot because a lot of those casuals might have lost their jobs under COVID-19. And now they hear that, they should have been entitled to some other benefits that they weren't receiving. So this is a hot topic. And then, obviously the potential impacts are big. We're talking about the big negative publicity, the impact on the brand, obviously the liabilities that have to be recognized and paid out, potential penalties and fines, etc. So I don't want to go on much longer. I'll rather get the experts to bring this together. So I'll hand over first of all to Ben Renshaw, who's a tax partner, and then we'll go to Mark Griffiths to bring their perspective on what they're seeing. They're currently working with clients on this.
Thank you, Aletta. Good morning, everybody. It's very nice to be here. As Aletta has indicated, I do a lot of work in the space these days of what I call pay compliance and what the press like to call wage theft. And it really does sit quite heavily around whether organizations have paid their people correctly, primarily under the appropriate award or EBA that's in place. There's a few reasons this comes up, as Aletta's indicated. One is when organizations realize they've made a mistake historically that they need to rectify. More common, however, is when a disgruntled employee makes a complaint to a union that finds its way to Fair Work, and Fair Work commence an investigation. Fair Work's approach to this is to ask for everything in terms of employee documentation for an extended period of time and make it a big activity. So what we're finding is either clients are coming to us and going, well, we need to look at this because we've made an error, or we think we're okay actually, but we want to look at this just to make sure that we are okay now and we'll be okay in the future. And it comes really down to the complexity of a couple of things, right? The complexity that's embedded in modern awards and EBAs. They're not straightforward documents to fully understand. And the complexity along with that comes with time and attendance systems, where you've got workforces who aren't your standard 9-to-5 employees who are working on a roster basis or casual basis, particularly once you get into shift work or night work or weekend work, and all the complexity that goes with that. So probably every second job at the moment is a review of that aspect, and we tend to find mistakes in every single case. And as you've seen, I'm sure from the press pre-COVID, this was a very hot topic. And we've worked with a number of organizations, unfortunately, that haven't come through the process, that have found that they've been paying people incorrectly since the dawn of time, and it's ended pretty ugly. And we've worked with plenty of others who have gone, well, we want to review, a 15% or 20% sample of our organization to make sure that we're compliant on award and EBA type activities. The other piece that sits alongside that in the pay compliance bucket, for me at least, is superannuation. So super, on the face of it, is pretty straightforward. 9.5% isn't a complicated calculation. But there's a few things in that, right? And one is that super is obviously payable on ordinary time earnings, and understanding what goes into OTE adds some complexity. But the reality is super calculations are driven heavily by payroll configuration. And it only takes one mistake or misunderstanding or incorrect use of payroll configuration with the wage code not configured properly for super to lead to a superannuation mistake. There's no statute of limitations on super claims. An employee can come to you and ask for their super that's been underpaid since super was introduced, which I think was 1992, I'm going to go with. So that can be problematic. So one small mistake in payroll made 10 years ago can have big consequences. So we often get asked to review configuration of payroll to make sure it's configured properly for super, and then where errors are found to do the longitudinal review to understand how much of a problem there might be. Now, the reason that this is topical is that there is a 6-month superannuation amnesty in place with the ATO, which runs out in early September, so there's only a few weeks left of the amnesty. It was a 6-month window the ATO and the government created for organisations to come forward and say, well, we've underpaid super, we're going to make these catch-up payments, we've figured out how much it is, and you're able to, it's currently able to do that without penalty, without admin payments, and retaining corporate tax deductibility of those payments. Once the amnesty ends in a few weeks' time, then the legislation actually dictates significant penalty increase, no corporate deductibility, and I think we'll see an uptick anyway in compliance activity in this space once the amnesty period's over. Because of COVID, obviously, it's been difficult for organisations to focus on the amnesty. Nonetheless, the ATO have indicated they're not going to extend the amnesty timeframe. So it really is a now or never sort of opportunity to fix any skeletons in your super config and payroll in the most friendly way possible. I think now I'm going to hand over to Mark. Mark and I work together on these things. My area of expertise really is in the compliance and remediation space, and Mark and I work together because what's also important in this area is the process and control piece. So I think I'm handing over straight to Mark. Is that right?
Yeah, thanks, Ben, and good morning, everyone, and thanks, Aletta, for giving us this opportunity. I have to say, when you invited me to join, we were talking about IFRS, that I wasn't expecting so many comments around risk and governance, so I got very excited very early on, so thank you. Ben's right in regards to the work in this area, particularly around identifying underpayments, is often related to an issue in regards to the payroll itself and how the payroll system is being configured, but also then the controls that an organization might have in place in ensuring that any adjustments to pay awards, etc., reflected in payroll systems are being validated and reviewed by an organization. So that's where Ben and I are complementary in the work that we do for our clients in this space. Also from our perspective is around what assurance as an organization might you be getting in this space. So do your auditors, be they internal, be they external, are they providing you with any assurance in regards to your payroll controls? What we find, certainly in my experience, is that the payroll has become an area that, prior to the many issues that Ben has alluded to and Aletta has alluded to in regards to underpayment, is an area that historically would have been something that would have been reviewed on an annual basis. So payroll controls would have been reviewed annually. For many years prior, however, it's an area that's just been ignored because there are other risks that organizations have been focused on. But right now, this is an absolute hot topic. So I guess the encouragement for you through this webinar is to have a look at those controls, and certainly that's an area that myself and Ben can potentially support you with. That's probably all I wanted to say. Aletta, I think I might be back to you.
Thank you very much, and thank you, Ben, for your time today. So what I've also done is I've included a number of articles that Ben and Mark have written around superannuation guarantee, underpayment crisis, how do we move forward, and employee entitlement, wage theft and fair work. It's articles that's available on our BDO website, and I've given you the links And then I saw there's a podcast on, I think, the very last link. And I've never done a podcast, so I thought, okay, that's an interesting one. It was done by Ben for Accountants Daily. So if you wanted to look at that, where he talks about this, please feel free, and also to reach out to them. And I should also say, if you contact Kevin or I, or your BDO contact who you usually deal with, or you contact Ben and Mark, and you would like to know who's the best person to speak to wherever you are based across Australia, we can put you in contact with that person. Absolutely. So just let us know. Please feel free to reach out. Coming up as number 7, Kevin, is an interesting one. And this is the risk around reporting framework. And I would imagine the reason that this has come up is because we know the AASB is working on removing the reporting entity concept. And there's a lot of talk about, when will you have to prepare general purpose financials, tier 1, tier 2. There might be some specified disclosures required. When can you continue with special purpose in limited situations, etc. So this has been coming for years and years and years. And it looks as if it's reaching the pointy end now, and we're close to change. And I know for profit, we're very close to reaching a change, but for not-for-profits and public sector, it's still running a little bit of a way. But there's been uncertainty in this space for a long time. It's a big risk for an organization, because if you are applying the wrong reporting framework, it means that you are applying the wrong accounting standards. And if you're applying the wrong accounting standards perfectly, you're still wrong, right? So the starting point has to be, what is my reporting framework? Therefore, which accounting standards do I have to comply with? So I think because there's such uncertainty, because the earth is moving under us, this definitely might be the reason it's coming up. The other thing that's at the bottom of this slide is we know that the ATO introduced a requirement for SGEs to prepare general purpose financial statements, and there's a huge penalty if you get that wrong. And then, the legislation came out, and there were some transitional requirements. And fairly recently, there's been some changes to that definition of a significant global entity. Actually, in our accounting news in August, we talk about the latest changes. And there's now also country-by-country reporting requirements or reporting entities. So in a way, the definition of an SGE has extended. But also in a different way, you only have to prepare general purpose financial statements if you're a country-by-country reporting entity. So again, there's uncertainty, there's complexity around that. And if you have to lodge general purpose financial reports with the ATO and we're talking, big dollars, really big dollars. So, impacts the application of incorrect standards, etc. And I think the big thing when you get it wrong is that big penalty by the ATO. So I think it's really important for boards, for finance team, to keep their eye on what is changing around reporting framework, what is the AASB doing in this space, when are the new requirements to prepare general purpose financial statements come into place for for-profits, not-for-profits. I know, there are certain transitional rules that is trying to encourage people to early adopt the preparation of general purpose. And if you make use of that opportunity, there's like real benefits. So COVID-19 has again made it difficult. People don't want to move to a new reporting framework while they're struggling to deal with COVID-19. But I believe 30 June 2021, I would early adopt, because if you wait till 30 June 2022, there's no transitional assistance and transitional requirements, and you'll find yourself in a difficult spot. So reporting framework was interesting. The next one, number 8, around foreign exchange. Now, foreign exchange, if we've got significant overseas activities, subsidiaries, branches, Absolutely. I could understand that there's high risk to get that right. Also, if we have transactions, sales in foreign currencies or imports in foreign currencies, or we're raising funds, incurring loans in foreign currencies, absolutely this would be a big risk. A risk around how we manage it. Do we hedge? Or not, and even if we hedge economically, what does that mean for accounting? Because that doesn't automatically get us to hedge accounting, and we know hedge accounting is complex again. And if you think about foreign exchange, Kevin, I think it links back to cash flow again, because if people want to manage their foreign exchange transactions, it's about managing the cash flow and securing the cash inflow or the cash outflow, whichever it may be. So there is definitely a reason to economically hedge these type of transactions, but we know there's a disconnect between economic hedging and hedge accounting. So are we getting this right? And definitely a layer of complexity, which was listed earlier. So that's foreign exchange, big area. Number 9, significant estimates and judgments. Now we know that we have a requirement in the accounting standards to disclose significant estimates and judgments. More and more accounting standards require entities to make significant estimates and judgments. And I'm thinking about the new revenue standard and the new lease standard. And it's all about the facts and the circumstances and your entity's business model. And based on all of that together, what would be the best estimates for you? And if you make certain estimates and certain judgments, to communicate that to the users so that they're very clear on what estimates and judgments you've made. So I think it's really important that this disclosure has always been there, but it's more entrenched. The whole estimation is more entrenched in accounting as we go on and as we get new standards, and to link that with the communication piece, which is what financial statements are all about. So I think absolutely fantastic that it's come up in the top 10, that we have to consider these estimates and these judgments. Do we have position papers in place that we can defend? Do we adequately disclose it? Do we have realistic assumptions? We're not being overly optimistic and pessimistic. And also, how do these estimates and judgments tie together across different areas within our financial statements? And then the other thing that's really interesting, quite often you make certain estimates and judgments, but the interesting thing is, the sensitivity analysis. So if I made a slightly different estimate or judgment, what would the impact have been on these financial statements? So it's kind of flagging the risk associated with this particular estimate and judgment. So the next one is number 10, and this is another interesting one. Finance teams came up in their top 10, the audit relationship. Now, Kevin, I'll throw the audit relationship over to you.
Yeah, thank you, Aletta. And I've been pondering this one all morning a little bit, and I think it's because audit is obviously tied to financial reporting, and I'm starting to wonder if the reason why it's there is because a realization is dawning that audit isn't anymore a compliance issue, because it's also linked to financial reporting, which isn't really a compliance issue either anymore. And there's a little bit of a story here, and I think I should probably kind of walk us back a little bit. 10 years ago, I think the standard setters realized that the accounting standards didn't seem to be delivering the result into the financials that tied into, shall we call it, the business and economic reality. And we're still here today, a lot of directors and finance teams saying things like, the financial reportings don't represent the economic reality. But what's actually been happening in the background is the standards have been moving forward to try and capture that, which is where the lease standard and the revenue standard and the financial instrument standard, they all were designed around contracts and legal principles and economic reality. Even things like goodwill and impairment, which are what I talk passionately about. And over time, what's happening is an accounting standard set that is designed to capture what's really happening. And it actually leads into what you've just spoken about, significant estimates and judgments. The reason why that's also on the list, I think, is because more and more accounting standards aren't the sort of thing you do at the end of the year on a compliance-based measure. You don't just do the financials at the end, you make your adjustments. They really do represent what's going on in the organization on an ongoing basis. And financials are becoming entity specific more and more, which is where significant estimates and judgments come in, because judgments and estimates are the application of estimates and judgments for that entity according to the accounting standards. And every entity is going to have some sort of variation that's specific to them, which is captured in estimates and judgments. That all said, by the time you get to the audit, the auditor needs to evaluate and audit those judgments and estimates, let's say. And very often what happens is there's this breakdown of collaboration because the auditor is in some ways still seen as just a compliance tick box type approach at the end of the day. So I think this has actually been coming on there, and it's a good thing, because the fact that it is in or is number 10 on the list, I think, is saying things like, maybe it's time to work collaboratively with the auditor, because their role is a trusted advisor. It is important to have them in early on. And if you don't have that in case, what ends up happening is this breakdown at the end of the audit, no consideration in terms of what their role is and how they should actually participate, and it really just actually all falls apart right at the end. So long story short, I'm glad to see audit relationship is on the mix, because they do play an important role to challenge judgments, to challenge management's assessments and estimates, to challenge acceptable accounting standards, to look at what the auditor, what the boards and finance teams are doing in terms of accounting papers and accounting policy selections. And it links with things like significant estimates and judgments in particular, because that is a way to reflect the economic reality. So good on you, glad to see audit relationship there. But I guess my only takeaway from that is, if that is an important concern, I'm wondering what the fix is. And I guess it's things like bringing the auditors in earlier. You know, a lot of auditors go in and they're involved in things like interim audits during February and so forth. And I think the interim audit is actually sometimes completely undervalued in its place in the process. I sometimes think that the interim audit is where all the big issues should be identified and virtually resolved before you move to year end. Because if you're picking up big issues at the end of the year, I think the audit relationship is probably not being adequately integrated into the whole process. So anyhow, enough ramble on that. Aletta, back to your favorite topic in the whole wide world.
That's right. I think if I go back to the audit relationship, Kevin, I actually, when you look at the audit, there's a very important thing to remember on audit, and that is independence. And the fact that, the value of this audit is this independent review and audit of what the finance teams have done. And therefore, although I think the audit relationship is critical and that one should work collaboratively with the auditor, I also believe it's important that we continue to focus on maintaining independence. And I often, when I look at the next slide where we talk about potential impacts, if there's no collaboration and we get the auditor in too late, are we just rolling over as finance teams and accepting the auditor's judgment without challenge? And I think that's a risk for organizations, because I think if during the year you've done your work and you understand your business and you've put your position papers together, you know the business, you know the risk, you know the estimates, you have the judgments, and you've documented it. It's a really great opportunity to be challenged by the auditor. Right. But it's important to not just accept what the auditor says, but have the debate. Yeah. And I think that's where independence is so critical. That's why we have advisors separate from auditors. I know even at BDO, if we do IFRS advice, or we're around working with clients around, let's say, accounting guidance, it's important that management still make the decisions, that management understand the decisions, and that management is then able to have the conversation with the auditors around it, and that we have different teams working with a client, so we can't get an audit team providing guidance and advice as well as auditing. So I think it's important to remember independence, because independence is critical in the role of an auditor. Okay, number 11. So lease accounting didn't make the top 10. I'm devastated. But anyway, here we are, number 11, lease accounting. So huge risk, of course. 30 June 2020 is the first time we're implementing the standard. So there's a big risk. It's a new accounting standard. The other thing that I'm finding is while we're working with clients and doing all these lease calculations and initial implementation, preparing the journal entries, assisting with the disclosures, and the disclosures is fairly hectic on the new AASB 16, the one thing that continues to come up is how finance teams and boards are surprised by the sheer size of the lease liability coming on the balance sheet. They are surprised by the number of estimates and judgments that they have to make and the huge impact that estimates and judgments have on the size of that lease liability around lease term, around incremental borrowing rate, etc. They're also surprised, number one is the size of the lease liability, but the second thing is obviously the estimates and judgment, but also the extent to which those estimates and judgments have to be supported and linked to how they run the business, and how important a particular property is. So if this is a fantastic property and we will stay here for the long run because it's got certain economic value for us that we would protect with everything, then it means although that property is on a month-by-month lease, we should capitalize it for a much longer term. And then it brings a commercial question. Hang on, if this property is so important to our business, why are we running the risk of having it on a month-to-month lease? Shouldn't we lock it in for a longer term? Because we've just gone through this process and we've said it's important for our business. So I think what I find really fascinating here is the way that this accounting standard is making people reconsider commercially the importance of the various leases. The one that grabs their attention is the lease liability. But then it flows down into a lot of other things. The one that I've dealt with for the last month, which I want to warn you about, is the disclosures. So the first time you implement the standard, there's a lot of disclosures and there's a lot of transition disclosures that you have to reconcile what you're doing this year under AASB 16 with what you've disclosed in your financial statements last year, the commitments note. And it's often when you start to do that reconciliation for disclosure purposes that you realize that some leases might have been missed and some estimates and adjustments have to be reconsidered. So I would not leave those disclosures of the new leasing standard till last minute. There's a lot of work involved and it raises a lot of questions. Kevin, I'm back to you on fair value.
Yes, it's not often that I go back to kind of reiterate a point that you've just made, but I have to support what you've just said about the reconciliation in the leasing standard. And it comes back to what Mark mentioned about governance and risk. It has absolutely astounded me as part of the lease accounting project for the organizations we've been involved in, just how unchecked and unregulated, shall I say, within the organization, the leases are. So, and I'm probably referring more to property leases, yeah, but obviously it's not exclusively. Fleet management and motor vehicles seems to be very well managed, and I think it's probably because there's a tax impact and employee benefits and so forth. But on a property lease basis, we've had some situations where clients have 20, 30, 40 leases, and the reason why the board is surprised at the size of the lease liability is because they didn't realize that they were committed to that. They didn't realize that the lease liability is essentially a representation of the amount you are committed to. It's the committed to liability, essentially. And if you actually never saw it on the balance sheet before, you didn't know how big that number was. Now, what was supposed to be happening in the past was exactly what Aletta mentioned, disclosing the commitments to operating leases. That was what was disclosed previously, and the pure extent of error between what was previously disclosed as lease commitment and what ultimately is now being capitalized as committed lease liability has astounded me from a governance and a risk point of view, because there was virtually no, I mean, we're talking millions of dollars in some cases where the board just didn't realize how big
Millions
the
and
commitment
millions.
was.
Yeah.
So that is a fundamental. I'm actually spending more time on the slide because I think that may be the biggest risk, I think, from a financial reporting that I'm currently embroiled in during this reporting season, other than, let's say, impairment and some of the other big COVID-related issues, is that realization that the reported commitments in the operating lease commitment note in previous years was just so fundamentally misstated in terms of the actual commitment. So yeah, I'll leave it at that and say, very good observation, Aletta. I 100% support you on that one. On fair value is an interesting one. Also, it kind of goes with impairment on one hand because it is one of the big components of impairment. But fair value conceptually is actually just widespread throughout the accounting standards. You think of things like financial instruments and a number of other accounting standards where fair value is inherently embedded in those standards. The reason why it's on the list, I think, is because there is, especially at an audit committee or board level, this undying commitment to the fact that financials are based on the historical cost convention. Now that is for the most part still true, but it's not really as true as it used to be 10 or 15 years ago. Historical cost is I guess a foundational measurement issue, but fair value has crept in everywhere: investment property, impairment, financial instruments, biological assets. It's everywhere. And so fair value becomes a problem because the expertise involved, lack of information, expertise involved. And I think one of the big issues is the cost involved, because these are generally external valuers that need to be brought in to actually do this. But the other big trick here is that fair value for financial reporting purposes is very different to fair value for another type of purposes. If you're valuing something for insurance purposes, or you're valuing a business for purposes of an economic transaction, the values can actually be very different. And so there's a galloping shock that comes to a lot of boards when they realize that the valuation they got, let's say, for a piece of for a business, can't actually be used for financial reporting purpose because the underlying frameworks are different. So the fair value, there's this big thing about market value, fair value. What do they all mean? But fair value for financial reporting purposes is quite a specific meaning. It's widespread through the financial statements. It requires time. It requires information. It requires expertise, which means it requires cost. I'm actually surprised this is outside of the top 10, because this is something that's going to come and hurt you down the track. Aletta, I'll hand you back to board involvement.
Thank you very much, Kevin. So in number 13, we've got board involvement. Now, I have to admit, when we've developed the financial reporting risk assessment, I threw this in as a little bit of a cheeky one to see how finance professionals will respond to this, and finance team. And I really thought about or how I've described it is, whether audit and risk committees or boards, do they have the adequate opportunity to ask questions before they finalize financial statements? So, does the board have that adequate opportunity? So it really is, we're all so busy, we're running so hard to prepare the financials. And then ultimately, we put these financials in front of an audit and risk committee, a board, and they have to review it and approve it. And there's a lot of risk and responsibility sitting there. But are we really giving them enough time to have interactions with the finance team or the executives? Do we give them enough time to review? Do we take them on this journey throughout the year? And I think Kevin said something beautiful earlier when he said, financial reporting is not just a compliance exercise. at the end of the year. This is really linked to our business model and how we run our business, and we thought, and the contracts we enter into, etc. And therefore, are we taking our board on that journey throughout the financial year as well? So it's an interesting thing again, are we just allowing, you won't believe it, my dogs are going crazy. I'm in lockdown in Melbourne. There's somebody at the front door. I've got 3 dogs, 4 children, and it's chaos at the moment. So I do apologize for that. A little bit of lockdown fun. Hopefully somebody will come and rescue me soon. Kevin, maybe I should hand over to you until my dogs...
I'm happy to take over a letter and talk through some of it. So if we move forward, and Aleta's driving the slide, so I'll actually just ask her to drive that for me, if you don't mind, Aleta, while it's on mute. I know that you might actually run to go answer the door. Uncertain tax positions. I'll talk very high level on this one. Uncertain tax positions is one of those scenarios that kind of came out the blue a little bit, in terms of how you measure the number when you've got an uncertainty in a tax position, let's say with the ATO or transfer pricing policy, that perhaps it's maybe not quite certain it's actually going to be accepted by the tax authorities. There was a lot of concern around this before it came out about what this might mean for financial reporting, and especially in terms of disclosure, giving away your position or your situation. But I'd actually like to just spin it around and say that I think the biggest issue here with uncertain tax position is, once again, not only the incorrect disclosure of liabilities or the measurement of issues, but it's actually just the fact that it's meant to represent the probability weighted outcome of an uncertainty in a tax position. Now, it doesn't apply to all uncertain tax positions. It only applies to a certain group of them, and it's really those where there's like less than a 50% chance or probability of it being accepted. But what it actually does is it tries to actually apply something similar, not exactly the same, but similar to the provision standard, where you measure provisions of uncertain amount and timing on a probability weighted method. That's all it's trying to do. But it is true, it impacts tax, and that impacts cash flows, that impacts tax accounting, it impacts disclosures. It's quite widespread. And so I'd say that this is a big one, and I'm glad to see it on the list again, because it kind of goes all the way up to the board and the audit committee again. This is one of those issues that, because the accounting is reflecting this on a provisional type basis, you really need to take everybody on a journey, because it's enormous business risk. It's not just an accounting risk, actually a business risk.
Thank you very much, Kevin. Thank you. I'm back. Thank you for saving me from the chaos here at the Boss of Home. I really appreciate that. So I suppose the last few ones, Kevin, staff competency is another kind of tongue-in-cheek one. Now, remember my comment, tongue-in-cheek. Because when we look at the results very soon, you'll see staff competency actually come up quite a lot. So although when we looked at it overall, it was fairly low, but there's certain parts that appear later on in our risk matrix. So I've said do the finance team have the skills and the resources to prepare the financials, and it's not just, do they have the technical knowledge, do they have time? A lot of finance teams have been cut down over the years. So do we still have the time to do all these important things? Do we have training on all the right things? And it's not just IFRS, tax, etc. Do we have the adequate resources to do what we have to do, and the relevant experience? And obviously, again, if we don't have those things, a lot of things comes down to maybe accepting the auditor's judgment without challenge, which is not good for independence, and maybe not aligned to your business model either, and maybe not the correct commercial outcome. So staff competency is a little bit of a tongue-in-cheek. Accounting standards compliance. Kevin said earlier, accounting standards and financial report preparation is not just about compliance, and this is really a good indication of it. It came in at number 16, Kevin. Yes, we have to look at new standards. Yes, we know we have to comply with it. To me, I think this is indicative of the fact that it is like business as normal. We know we have to do it. We accept it. It's not a huge additional risk. It's an accepted business risk, is how I saw it. Government stimulus is definitely something at the moment with COVID-19. And I know last month we talked about government stimulus and how to account for JobKeeper and all the various stimulus packages. And I think what this is saying is, the risk around government stimulus is, am I applying for everything that's available to me? Because it's a risk if I'm not applying. It's a risk to my business. If I'm applying for it and I'm receiving it, there's a risk that I can't withstand the ATO audit when that comes around. That's another type of risk. But maybe the reporting of the government stimulus, people don't see that as a particular big risk. They know how to do that. Government stimulus, I really think it's really important that you make sure that you can withstand that audit, which we know is coming. My tax partners are telling me that the ATO is focusing on this to make sure that all this money that's been paid out through the various measures based on applications, that's been self-assessment applications basically, that they'll now audit that and make sure that they should have paid that money out. The last two ones are around process risk. I thought, do we have the processes in place? And I think most people rated this low because they do believe they've got this, the processes in place for the new standards and to apply the standards, etc. And then finally, communication. Now, this communication was a little bit of a shock because I've always thought that the preparation of financial statements, number one, conceptually high level, is about communicating the financial results to the stakeholders and the users. So when I prepare financial statements, I personally would have thought it's all about communication. So we have to make sure that we've got enough time to discuss critical issues, that we properly communicate, disclose it, that we anticipate the questions that shareholders and stakeholders would ask, and that we really engage with all these people. So for me personally, I thought communication, this is just, I'm a former academic, so give me this one. Conceptually, I thought this should have been number one. It came in number last. So I must be quite unrealistic. Maybe there's too much of the academic left in me. So now for the interesting insights. Which risks were identified as most relevant to the finance team? So when they started, which risks got the most, let's say, swipe right? Which ones? And this is interesting. The ones that they thought were relevant, most relevant, was accounting standard compliance, lease accounting, it's new, fair value, impairment, and staff competencies. So these are risks for us. These are the most relevant risks to us, which was interesting. However, when they then looked at the risks most relevant to them, and they said which are most likely to impact them in some way. So, it's likely it's going to impact us. Staff competency came up number one. So if we've got a problem around staff competency, it would most likely impact you in a way. Then it was impairment, it was lease accounting, it was recognition of grants, it was foreign exchange, it was cash flows. So this most likely notion is all around I would say, the probability of this actually happening. And staff competency was a high one. And then the next part of this assessment is which risks are most likely to have a serious impact. So this is now when things go wrong, whether it's probable or not, when it goes wrong, how big is the impact, all right? So like a risk damage assessment. And the number one is cash flows. I mean, if cash flows are wrong, we've got a problem. And it impacts the viability of an organization. So, when that's wrong, the impact is huge. The recognition of grants is huge for not-for-profits. Remuneration is huge, Ben and Mark, because it impacts penalties, it impacts brand damage, so the impact is huge. It's big impact. Complex transactions, revenue recognition. So I find it really interesting to look at you know, looking at what is most likely to go wrong, and then, you know, what would have the biggest impact, kind of separately. And then when we combine the two and we say, which risks do you have to manage very closely to ensure you meet your financial reporting requirements and deliver a smooth and a successful audit for your organization? Quite amazingly, the not-for-profit ones around recognition of grants came up number one. Then cash flows, impairments, revenue recognition, foreign exchange, remuneration, complex transactions, staff competency, and fair value. So it's really just cutting and dicing the information in different ways. Now, when I looked at all the people who responded to this and I put it on one matrix, and, you know, put the average scores on one matrix, this is what it looks like, which is very interesting. So if you look right on the left-hand side, number 18 is process management. We've said minor impact, very unlikely to happen, all right, is process management. The interesting one is the number 2 on the other side, huge impact, very likely to happen. Number 2 is recognition of grants by not-for-profits. Interesting. If you go to the next level and you look here, number 1 is cash flows. The impact is severe on average and very likely to happen. You know, and if you look at this kind of level, you know, you look at the diagonally board competency, revenue recognition, we look at foreign exchange, we look at impairment and lease accounting. It's like the next layer down, because your biggest potential risks would be high impact, very likely to occur. So the number 2 there, and you work down to, on this side, the minor and very unlikely to occur. So kind of an interesting risk matrix across everything we've discussed today. So again, thank you very much to everybody that participated in putting that together. Maybe to move on, I just want to reiterate, I think it would be interesting for you to assess or get your board to assess the financial reporting risks. And maybe get your whole finance team and executives to assist it if you invite them to your team. You can then compare the difference between the risk assessment of the board and the finance team and even individuals within the finance team. And then ask yourself, have you really addressed or managed all the risks that you've identified, especially those identified by the board? And then finally, my question is, are you audit ready? Because I would imagine all of these risks, whether identified by the board or the finance team, would have to be considered and addressed in order to be audit ready before the auditor arrives. I would like to say that next month we want to focus on board members, and in particular what they should look for when reviewing financial statements. So what are the big ticket items for 30 June 2020? It would be really interesting to get board members' perspective on the risk assessment. So if you wanted to share the app with them, I think we'll do something similar for next month's webinar, and get a board member perspective. It would be great if we can get board members to complete maybe an assessment for next time. This month's newsletter and our IFRS publications. The newsletter is on my desk to finalize today or tomorrow. We focus on casual entitlements, remuneration underpayments, the new significant global entity definition, recent ASIC media releases. We look at the Melbourne lockdowns and is it an adjusting, non-adjusting event? How does it impact impairment testing? And we also have 2 new publications. There's an impairment of assets publication, a beautiful publication, and there's IFRS at a glance, which I think is a nice publication for board members because it's basically an accounting standard on a page or a few pages, but it's trying to, at a very high level, summarize all the accounting standards. So that would be good things to look at. We have a number of free resources as always available: accounting news, webinars, interactive e-learning, etc. And then I suppose finally the question is, do you need help to be audit ready? Are you across the preparation of your position papers? Are you happy that you achieve commercial outcomes while still complying with Australian accounting standards? Do you need a fresh eye to look at your financials? I've put in again there the lease calculations and the disclosures, which is really problematic. And then also, do you need assistance with these discussions with auditors? I've had some situations where I've worked with clients in an advisory capacity, and then when they have discussions with the auditors, they would come back and say, Aletta, the auditors are talking really technical language. You've helped us. We understood what you said, but can you please join the conversation with the auditor? Because we feel we need a little bit of, let's call it firepower, when we have this conversation. So I think it's important that we're also happy to have these discussions with your auditors to make sure we have the independent, challenging debates. If you look at our BDO IFRS advisory team, so you can always contact us if you need particular assistance, and you'll see we've got a new partner in Perth, Ashley Woodley, so really exciting to welcome her to the team. I think I'll leave it there, and I'll say thank you very much for joining us today. I hope you found the insights helpful. Please feel free to reach out to us if you need assistance. And I hope you could get some of your board members to join us next month when we talk about the things they should be looking at when they review their financial statements. What are the big ticket items? And if we can potentially contrast and compare what finance people or finance teams focus on as opposed to what boards want to focus on. So finally, I would say, Ben, Kevin, Mark, thank you very much. If you've got final comments, you're more than welcome to do that, to make them.
Not from me, Aletta, but thank you again for everyone that's attended and for giving us the time to speak.
Yeah, likewise. Thank you, Aletta and Kevin and Ben. I really enjoyed that session, I have to say. Learned an awful lot as well, but as I said in my session, really happy to hear about the focus on risk and governance and as part of the IFRS focus as well. So thank you, guys.
And myself, thanks, Aletta, and goodbye, everybody.
Goodbye, everybody. Have a good day. Take care.